Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Michael Normyle, U.S. Economist at Nasdaq, Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk, Steve Sosnick, Chief Strategist at Interactive Brokers, and Chris Englebert, Founding Partner and CIO of Englebert Investment Advisors. We are here to discuss how sustainable near-term buying momentum is heading into 2025, given elevated expectations and valuations. It is great to actually have the band back together, same exact band
yes.
that we had in September, and what a different conversation, Steve. I mean, the election was over, discernible result, concession happened, started to hear about some potential policy strategies, and the market appears to like it.
Well, the market likes it, and the momentum has been solid. The trend is your friend is a good adage to live by for most of the time, and this has been the case. And the market has been able to project what it wanted to onto the new administration. It's business potentially demonstrably business friendly and lower regulations. These are potential for tax cuts, or at least not tax increases. These are the things that investors want to hear. We have a honeymoon period until inauguration, because all the stuff that investors might not want to hear can't happen till then. Tariffs, you can't do an executive order until you're the chief executive. Some of the other stuff that might be a little less market friendly, at least in the short term, we'll have to wait. So right now we're in a market where momentum has been the number one factor driving prices. The market can keep doing what it's doing, at least for now, and we'll talk about the for later.
Yeah.
Later.
But Chris, you have to ask yourself, when it comes to valuations, until these policies and reforms and a decision on tariffs and taxes come into play, it's got to be tough judging your forecast for 2025.
Yeah, I mean, we're seeing FOMO, fear of missing out. Like last time I saw this as a seasoned advisor was 1999. I mean, I hate to bring up shades of 1999, but you had this huge pent-up demand before the election. The election happens, and now investors are saying, okay, I want to be long everything. I mean, there are record flows into cryptocurrencies, equity ETFs, large cap, the Mag 7's coming alive again. And I mean, it's exactly the opposite of what we had in February, during COVID, where everybody was like, get me out. Now, everybody's, literally, I'm getting phone calls, should we be all in now? And I'm like, we put together in our shop a slide deck showing the valuations, and at some point valuations matter. I don't know, going back to 1999, there's going to be one day, 1 week, 1 month where everybody comes back and says, gee, why were investors so happy? And it's funny, we were talking pre-show about the post-mortem. And when you see the post-mortem on 1999, everybody's like, why were people buying something at 50 times earnings back then? And that's what people are doing right now. So we're really trying to keep people reined in and understand that now is not the time to go all in.
Which is so interesting, because it's counterintuitive. I mean, you and I had this conversation a couple years ago when there was more volatility in the market and people are more hesitant to take advantage of better valuations then. And I get it, it's human psychology. We've all spoken about this a number of times, but that's such a perfect example. We basically round trip that.
Yeah, it's only, this is, we just had Black Friday, and it was a really good Black Friday, but on Black Friday, everybody waits for lower prices to buy as much as they can. This is the only industry that I know of where if you have a Black Friday or a Black Monday, God forbid, and the market goes down 20% one day, people are like, oh, we can't be in. Now you got to get me out. Well, that's the antithesis of what's happening right now.
And Chris, it's so interesting. It's a perfect segue for you talking about Black Friday and Cyber Monday and so forth. I feel like there's a different name because people are obviously going to capitalize on these trends, right? You cover consumer names. You cover, the Nasdaq listed consumer stocks. It's been tough to bet on the consumer. They just don't. I mean, we hit record.
Consumer spend is great. You had a great 4-day, 5-day window. The numbers coming out that we're seeing, Amazon posted great numbers. MasterCard's spend pulse said the numbers were fantastic. You're looking at a lot of companies upping their forecast. Even companies like Dollar Tree that have been beaten up on the tariff trade had forecast good numbers, though that could be a problem, going to your point, of when January 20th comes and seeing what happens on the tariffs there, because most of their products are sourced from China. But overall, Christmas has already been bought months ago, and People are buying meaningful investments, meaningful gifts. They're not buying the socks, they're not buying little chutsy games that people get as gifts. They're buying things that people are going to use. So those who are spending more are doing better. And with that, you're seeing the companies that have those products that people want are doing very well. Amazon knocked us the ball out of the park, really did. And you're seeing a lot of other companies do the same. Walmart very well, Costco, we'll find out what their earnings are going to say, but I think it's going to be very well also.
Amazon's at my house like 6-7 times a day. It's crazy, and not to mention.
Don't you have a blue van with your name on it?
I know, right? And automated shipping and so forth. It just makes it so easy and convenient. Michael, I want to get your thoughts on some of the proposed strategies that the incoming administration is discussing. How can that impact inflation? What does it mean more so on the inflationary level, impact to the consumer, or is it, to Chris's point and both Chris's points, is it just too early to tell?
It's definitely, we don't know what the full policies are going to be, so you can't say for sure, but you can make a good estimate that if you add tariffs to things, that's going to make things more expensive. In terms of inflation, that's a one-time increase in the price level, and so that's going to push up inflation for a year, and then it's going to move out of that 12-month window that we look at, and so then inflation is going to kind of normalize by 2026, assuming the tariffs come through in 2025. But it is talking about the price level moving up and staying at a higher rate. It's just that it has a temporary impact on inflation. So it remains to be seen what will ultimately happen, but it's not returning inflation to the 7, 8, 9% inflation that we saw a couple years ago. It's maybe going from 2% to 3%. So it's a relatively small increase in inflation compared to what we saw, a couple years ago.
So that sounds like it's more normalized. We're not getting these extreme moves, which I would interpret as positive.
I mean, it's adding to inflation. So
right, well,
especially after what we've seen the last 5 years, I'm sure people won't be happy to hear about
year over year.
Yeah, exactly. Yes, I think a lot of the discussion that you hear about tariffs is how much it's going to add to inflation, and in real numbers, it's ultimately not a gigantic increase in inflation.
Yeah, and then Steve, if we take a look at the top 25 stocks at Interactive Brokers, at least the most active, not a surprise here, kind of aligns with what Chris was saying in terms of large cap, all the the companies that have exposure to the digital asset space, Mara, Coinbase, Palantir, another one. When you think about how spending is going to be reflected there, all of these names are exactly how the fundamentals are being translated.
It's pretty much, yeah. I mean, the list, which, most of these are NASDAQ listed names, mind you, so kudos. But, NVIDIA is perpetually number one. It was a little bit surpassed by Tesla, during the sort of the post-election run-up. What we've seen a lot now is a lot of activity in crypto-related names. MicroStrategy, Coinbase, Marathon, MSTU, because in case MicroStrategy isn't a leveraged enough play on Bitcoin for you, you might as well double that. And so that goes into the froth trade. Yeah. Also last week, because of the relatively low volumes in the market, we actually had 3 names. Every week I have to look up a name that comes into our top 25, and there's some name I've never heard of. It's got like a $35 million market cap, and it goes from like 2 to 12 and then back to 6 kind of thing. And we had 3 of those last week because, relatively speaking, the people who are going to be trading those names were still there, where a lot of the institutions were out. And so this is going on, and that's a sign to Chris's point about the froth. I mean, the fact that you have some company that maybe not be a micro cap, but a really, really small cap company, you've never heard of it, often foreign listed, foreign domiciled, I should say. And then we just sort of comes out of nowhere. There's some story, and off it goes running, and people pile into it, not just for like a few minutes, but for a couple of days, and then eventually reality sets in.
Especially when half the desk is on vacation, like a Thanksgiving week, liquidity profiles change a bit.
Yeah,
right?
well, those are not traded by desks. Those are traded by people.
Exactly, and that's what I'm saying. These move a lot quicker than a typical trading day.
Yeah, I mean, there was one today that I noted went from 4 to 12 and then back to 4 to 10 to 4.
Yeah, but most of those companies are microcap names. They don't have an institutional base, really minimal shareholders, minimal price, usually starting somewhere below 2, if not lower than that, potentially a higher short interest, and a very low float. And it's generally a meme name where it gets caught on social media that the froth kind of picks up on that. Those happen every day.
Well, that's what I'm talking about from a danger standpoint. I mean, the retail investor is getting set up at this particular point in time. Now, a lot of the desks are closed. The hedge fund guys are up this year. So they're going to make their 2 and 20. They beat the S&P 500. They're not shorting anything until January or the new year. But you have people chasing this money. And one of the problems I'm really having right now is everybody's like, get rich schemes. I got an email yesterday from a client, 3 or 5 crypto names that are going to go from $300 to $3 million if you put money into them. And people don't realize how quickly you can lose that money. So the first rule of investing clients' money is don't lose money for them. The second rule is look at rule number 1 again.
Right. Yeah, we go through this every 10, 15 years where there's some sort of over leverage in the system where we have to recalibrate our thinking in terms of, am I a short-term day trader who's highly experienced, or am I a longer-term investor? We've spoken about this countless times. Chris, by the way, 7 years for the show, right?
Wow.
One of our first guests.
Wow.
So I know the way that you think. What if you got out during COVID? What if you didn't stick through it in 2021, 2022? You can't time the market. So if you're a longer-term investor, like for clients that you manage, you shouldn't be worrying about these things as much.
Yeah, I mean, but there are periods of time, like when the froth hits in 1999, or what is very similar today, where you've got to take some money off the table. So one of the trades that's coming up that people aren't talking about is if you're a big institutional client right now and you've got money in equities, come the first of the year, you're going to be rebalancing, selling stocks, buying bonds to get back to your target. At that particular time, is that going to be the trigger? I don't know. But again, valuations at some point are going to matter.
Yeah, well, it's interesting, Steve, too. We're hearing recommendations of 70% bond equities, 30% alternative investments.
Yeah.
That's a new class, and not necessarily towards the pensions or the institutional funds. High net worth individuals, retail, you can get slices of these investments. They operate a little bit differently than liquid names you may be used to.
Well,
it's a lot, 30%.
But this is sort of, I guess, to me, the underlying theme is markets always operate on sort of a continuum between fear and greed. Mm-hmm. And I think right now we're at a point where we're very much on the greedy side and very much away from the fearful side. There's any number of things. One of the things I just worked on today is that index volatility, while it's incredibly low, and actually, if you want to buy out of the money puts on your major indices, such as NDX, but I did a lot of this with SPX as well. Interestingly, the relative spread between 10% out of the money puts and at money puts is about the highest it's been in 3 years. Yet on an absolute level, 10% out of the money S&P puts are about the low, they're about a 22 vol, which is relatively low, about the lowest it's been in 3 years. So you can look at it in 2 lenses, meaning that people are sort of saying, all right, I understand there's no volatility in the marketplace. I understand that there's no fear in the marketplace, but I'm going to buy that insurance now while it's cheap. Mm-hmm. Because they're definitely, the skew is quietly steepening. And this is why, I wrote about it in Barron's and shared it on our website as well, that, it's perhaps an opportune time, to maybe be a little fearful while others are greedy, or at least not be fearful, but you know what? You insure everything else of value that you own, and you actually hope the insurance doesn't pay off. Perhaps if you have a portfolio which has got some value to it, maybe you want to think about it in insurance terms. And I wrote about how those parameters.
To that point, if you look at the charts, we all know all the indices, every indice made new highs in the last couple of weeks. Yeah. And if you look at the trajectory of all the indices, including like the Russell microcap, the Russell small caps, mid caps, doesn't matter. Everybody's acting well. The counter trade is got to be out there, and it's got to be, to your point, cheaper because you're getting run over. How many of these higher highs are being created because people have taken that counter trade and are getting run over? They're hitting their risk parameters and having to cover because of a 8%, 10%, 12% loss. But if you look at the charts, I like to look at relative strength for all the different charts, and they're all bouncing up post-election, north of 70, which is overbought condition. They've all pulled back, but if you look at the S&P, the Nasdaq, even the Dow, they're all between 67 and a 70 today, again. So there's still flows coming in, but the breadth is different. If you look at the breadth for the indexes, right? Just today, the Nasdaq is up another 0.75%, building on yesterday's gains. You can look over my shoulder, tell me what it is right now. But there were more companies that were negative on the day than positive. Same for the 100, same for the S&P. So, and the mid cap is about 50-50. So when you look at that, you're telling me that it's the same winners that keep pushing everybody up, the Nvidias and the other larger fish in those ponds.
And this is where, Steve, you're thinking as an options strategist, and we covered something similar on Monday, noting that there's been some interesting volume around Nasdaq 100 callers on the index for that reason, and the way they constructed that trade, whereas when we were looking at trades around the S&P because of the diversification of the underlying stocks, that was a different strategy, but you can, the concentration risk in the Nasdaq 100, you could see why thinking about callers now, even though it's continuing to hit all-time highs, to Chris's point, as an option strategist, it seems prudent.
Oh, it is prudent. And by the way, you actually really can get most of this done in the NDX complex, because realistically, the NDX and SPX correlate. I don't have the number in front of me. Call it 97. The R squared is like 97, 98. It's incredibly high. And NDX has greater volatility than SPX. And really, it's the same leadership. It's just a bit more concentrated in NDX. So you can do whatever you need to do. It's just sort of, the VIX mindset gets people in SPX. But the idea of a collar trade, the interesting thing about a collar trade is you have to be willing to give away your upside. You have to be willing to say, I'm going to sell at this price, which in normal times is a great discipline. Fine, I'll be very happy to sell 7% up in 2 months or whatever it is. In this environment, you look like a sucker if you do it. And that's to Chris's point about the greed. Nobody wants to do that.
But Chris is also saying skate to where the puck is going to be.
Yeah, being from Minnesota, 10 above this morning. Thank God I don't live there anymore. But Wayne Gretzky had a famous quote. He's an all-time leading goal scorer in the National Hockey League, and they asked him why he was so great, and he said, "I always skate to where the puck is going to be, not to where it was." I love to look at asset classes and asset class returns, and obviously large cap growth, et cetera. The two most under-owned asset classes right now are long bonds and commodity funds. So long bonds, everybody's like, hey, why should I be in long bonds? The short end of the curve is up. Why do I need that risk in case, interest rates end up going up? And our take is a little bit different on that, because you're hedging what if the U.S. economy does slow down in 2025? Nobody's believing that right now. The other thing in the commodity funds is that it was a great diversifier in 2022. I mean, people piled into commodity funds. They were positive why the bond market and the stock market was down. Well, now if you look at these commodity funds, they've been under-owned and under-loved for going on 2 years now. And again, you got to skate to where the puck is going to be, because in 2022, at the beginning of 2022, nobody was buying commodity funds, and then all of a sudden you saw huge flows when they started to take off. We think that same trade's coming up in 2025, where people are disregarding what's happening with commodities and also long bonds.
Commodities, though, they can play, they could be in that ping pong game, right? When it comes to headlines. We did a piece on this yesterday with the senior commodity strategist at Invesco. The news about South Korea came out in the morning. That was on nobody's bingo card this week, right? And you saw the move in the commodity space for that reason. So it does show how it can counteract to the up and downside, with certain moves within your portfolio. And I think that's perhaps why you're seeing a broadening out in terms of where investors are interested to allocate capital, perhaps out of stocks and bonds.
Yeah, we think, again, it was a great diversifier in 2022, could end up being a great diversifier in 2025. And again, nobody's paying attention to these under-owned, under-loved asset classes. Now, small mid-cap stocks were that way, and all of a sudden in the last month, you've seen small mid-cap stocks, step on the gas and really accelerate. We still think that that's a trend going into 2025, but you have to skate to where the puck is going to be. You can't be chasing, and right now investors are chasing the same names over and over again.
They're using Wayne Gretzky's other adages. You don't score on any of the shots you don't take.
Correct.
Well, I mean, those are both very good points. Michael, as you think about going into 2025 and where the puck could potentially be on a high level, what's your macro perspective?
Well, I think the economy is going into 2025 with some nice momentum here. I think more or less you could describe the U.S. economy as a bit of a Goldilocks economy right now, not too hot, not too cold. We've seen some softening in the labor market, but not too much. Inflation's back right above the Fed's target at this point, and growth is on pace to hit close to 3% real GDP growth this year. So everything's looking pretty good going into next year. The latest labor market data we got this week from the JOLT shows that the quits rate ticked up, and that's a sign of people wanting to, feeling more confident about the labor market. the layoff rate ticked down. So we're in this period where hiring is relatively slow, but layoffs are also very low. So the labor market's kind of muddling along, but overall the economy's got some nice momentum going into 2025, and I don't see a near-term reason why that should change.
All right, and Dearborn, last 30 seconds here, your view into 2025.
It all depends on what Trump comes through with on his prediction. So everything that he campaigned on, and we know from the prior administration, is basically negotiation tactics. If you read his book, you know that and everything else. So we'll see if he follows through on the tariffs. If he does, that's going to have clear-cut winners like financials and energy, and clear-cut losers like anybody who's importing. If he comes through on the immigration issue, that could have impact to the labor market, which could be very negative to the market here as well. So it'd really wait and see until we get to that January 20th timeframe when he actually enacts in office. But really right now, you've got a very seasonably nice December. Hard to beat what we just went through in November, but still 2%, 3% is kind of where we've been historically. That could be very nice. I'll look to see what the unwinding happens in January with the portfolio balance, but I think equities are where you need to be right now.
And then we'll start climbing the wall of worry to the first 100 days in office and how he performs. All right, guys, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.